Hey guys, welcome to my first video here on YouTube on Alpha Trading. Just a quick info about us. We are one of the biggest prop firm trading channels in Germany. We have many subscribers and we have many information that could be interesting for you. And I thought I can practice my English a bit in doing these videos, and also you can get very good information. Today our first topic is how to get payouts on database. So we will look into the data of prop firms, how many evaluations get crashed, how many funded accounts get their payouts, and what are their behaviors that separates a very good trader from a bad trader. I will say we start with the first topic. So if we look into the statistics, and we have some good partners, we are partnered for many years now, and we know the statistic because they gave it to us. When we look at the success rate of evaluations and funded accounts, we will see that 1 of 5 evaluations accounts pass or reach the funded stage. That means that 22% that are bought, evaluations that are bought, are really gonna pass, so that are getting funded. Also, 12% of the accounts that are funded will get payout. So if you calculate a bit, you will see that only 2 or 3% in the end will get a payout. And so the revenue for the prop firm trading space is also really good. So if you have a prop firm, just 2 or 3% that are buying evaluations are gonna get a payout. Also, the trade frequency of successful accounts have an average of 2.5 to 3 trades per day, which means that the profitable traders are only making 2 to 3 trades per day, which is not very much if you look up to what some of other traders post on Instagram, on YouTube, or what you maybe do if you don't get consistent payouts. Failed accounts have an average of 7 to 8.6 trades per day, which is much more, even more than double, which is massive. So they are very over trading, and the good accounts that are with a good behavior and a good treatment so that they don't lose the account fast is that they only have 2.5 to 3 trades per day. Number 3 is that the successful traders always have a good risk-reward ratio, and that's one of the most important things. Successful accounts have an average risk-reward ratio of 2.4 to 2.6, which means if they are risking 100 ticks, they can earn up to 240 to 60, which means if they lose one trade, make one trade a winning trade. So if they have a hit rate of more than 50 or 50%, even just 50%, they are still more than profitable, because each trade they make, they gain more than they lose. And the failed accounts have an average risk reward of 0.5 to 0.9.5. So even with a 60% hit rate, if you only have a risk reward ratio of 0.5, it's still not enough to be profitable. And this is one of the biggest failures that many traders are making right now. If we look up what the failed accounts do and what the most common mistakes are in their risk management, we will see quite a few things that are done not properly. So frequent missing of a stop loss, in some weeks up to 50% of accounts. So that means that up to 50% in some weeks of the traders don't even use a stop loss, which means that if one trade doesn't go well, so if they are long and it goes short, they don't have a stop loss and can lose all their account in one trade. And many of the traders are doing that, like I said, up to 50% per week. Also, one of the biggest mistakes they are doing is that their contract size remains constant and is therefore not adjusted to the volatility, which means that if the volatility goes up, and maybe in the Nasdaq an ATR, so the range of a one candle, maybe 5 minutes, is equivalent to 200, so the median is 200 per 5-minute candle, and now it goes up 50%, so to 300, your stop loss also has to get a bit bigger, because if you don't change it, will get hit often or more often in your stop loss. And also, if you don't change your contract size, maybe from 1 mini to 0.6 or 7 micros, you will lose more and more fast, because you didn't adjust your stop loss and your size. And so that is a mistake that many also are doing, and very good traders also every day adjust their position size, always look what my stop has to be, where my stop has to be, which size, so that they lose always the same amount and not have spikes in their P&L. Like if the market goes up by 50%, their loss will also increase by 50% or even more, because they get even more in their stop loss. So like I said, the two most important points are the hit rate. So if you are over 50%, that means that more than 50% from your trades are green, and so a positive trade, and an average risk reward ratio is under 1 to 1, which means that they more often lose a trade, and then also they don't have a positive risk reward ratio. That means that both of the most important stats are red and not green. And so this is, in the risk management space, really the baddest thing you can do. So the last point is that the accounts are more frequently affected by news movements, which means they didn't prepare themselves for maybe like NFP, so non-farm payrolls, which are very important in this trading space, because when the NFPs are bad or very good, there are very big movements in the market, so that would affect their trades, and many times you will get a stop loss and not a take profit. And even if you get a take profit, it's just luck. So you didn't prepare yourself, you didn't look up what the news are saying, and it's very just gambling. So good traders, what they do instead is that they look up to like investing.com or Forex Factory maybe, or some other good websites where it indicates you where the news are, when the news are, if the news are important, maybe like 3 or 2 bulls, which means that the market will still or very react very strong, so that you can prepare yourself, exit your trade before, or don't trade before some very interesting events like FOMC, NFPs, like I told you. And that's so very important to prepare yourself before the news events are happening. So that was about the risk management. Now we will look up to the negative behavior, so what they are doing wrong and which emotions can lead you up to losing your account. So first of all, it's quite normal that you get into overtrading when you do too many trades and when you don't have an edge or strategy that helps you to make you profitable. So most of the failed accounts have more than 6 trades per day. Me, in comparison, I always do 1 to 3 trades. Most often I will end the day with 1 or 2 trades. 3 trades per day is very rare, and the market is very nice and I have very nice opportunities. So most of the traders don't look on the very best opportunities that the market gives you. They want to trade everything, maybe even 10 trades, 20 trades per day, and this is a behavior which isn't normal in trading. That's always just gambling. The second is scalping. So many of you like scalping, and I also like scalping, and I do it sometimes, but more often I use intraday day trading, which means that my positions go up to 15, 20 minutes, sometimes even more than 1 hour. But 70% of the failed accounts use scalping as their main trading style. So the most profitable accounts also, just for quick information, use very long-term trading strategies, even more than many days. So it's more than a position trading, a long-term trading. And the scalping, so the faster trading style in under 1 minute or under 5 minutes. So it depends which scalping you're doing. But most of the failed accounts are scalping up to 70%. So if you are scalping, the chances that you are getting a payout or being profitable is slightly lower, or much lower even, than if you are day trading or even swing trading. So if the time frame is higher, your probability to be profitable is also higher. Also, what I found very interesting is that the instruments that are used, so the markets with the highest failure rates, are the GC and Nasdaq. So the gold market for the future and the Nasdaq 100 for the future. And I think it's because the volatility is much higher than in other markets, example crude oil or ES future, the volatility isn't as high as the GC or Nasdaq. Also because the volatility is high and the order books are thin. So if you look the limits and compare to the ES or Nasdaq, you will see that there are much more limits in the ES than in the Nasdaq or the gold. Therefore, they need many trader traps to grab liquidity from the retail traders and from other traders, and that's why many traders get stopped out. And I think that's a reason why the highest failure are both of these markets. Now, if we compare the positive accounts to the negative accounts, And what they're doing good in their risk management is that 60 to 80% of their accounts always maintain a hit rate higher than 50%, and also their risk reward ratio is always higher. So that means very, very rarely they have a bad risk reward ratio. Sometimes they have, that's sure. It's just the most of the people that are trading very good have a good risk reward ratio and a good hit rate. So that means that both of the stats that on the bad side, so the negative accounts were red, and here the positive accounts, both of the stats are green. So they have a good hit rate and they have a good risk reward ratio. What positive accounts also do is that they trade less and hold trades which are open longer. So that means that their positive trades, they reach out their maximum potential and they let them run. The negative accounts, they always, many times, close their trades too early, which means their full potential isn't reached and therefore they can't have a good risk reward ratio. So the positive managed accounts always have longer open trades and also they are losing a stop loss. So if the trade doesn't go well, they are stopped out. But the positive trades, they are letting them go and maybe they are trailing after, but they don't stop their potential. Maybe sometimes it even goes more than 2.6 or even more than 3, but because they are trading very good and because they are letting the trade develop their potential, they also max out their profit. And also most of the accounts always, or not all, but many of them have an active stop loss and take profit. So that means their take profit is always very, very far from the entry and they stop much closer because they don't want to risk more than they can get. And it means that the take profit has to go far away and the stop loss don't. So, but what I think and what I know is that many of the profitable traders are trading their stop loss and their take profit often isn't very reached because their take profit is very far away and they are trading and to minimize their risk during the trade. Now let's look up to the positive behavior, what the good managed accounts do and what their behavior is. So first point is the volatility. Traders perform better during high volatility and trending days, which means that if a day is long or short, much more likely you will have an easier entry because, and in this example, it's really easy to understand. If we have a side day, a balance day, we call it, it's much more difficult to have a good entry. In the logical way, your entries have to be on the bottom or on the top, but many traders also go in here and always get stopped out because the market doesn't do like exactly like this. Oftentimes it does like this and then goes up and then stops again out and then do something like this. So it's much more harder for trader to understand how the market works when there is a balance. Also, we will make videos, or I will make videos to explain why the market does balance, why it does some trends, and what's important to understand. Because if you understand what the markets are doing, you will much more likely get easier trades also in side days. And if we have a trend day, maybe long, it's easier to get your trades always on the top or always on the low when we break. So it's much more easier, or it's easier for the traders to understand where the entry point has to be, where the stop loss has to be, and why we are entering there. Also, emotions are always a big part in trading. If we look up, positively managed accounts always last longer and close losers sooner. And which does it mean that the accounts last longer? If we compare to the crashed accounts, the most of the accounts crash within 7 days, within 7 trading days, which means that the probability that if you are not profitable and you have a funded account, the probability is very, very high that in the first 7 trading days you are going to crash your account. So the positively managed account sometimes have a lifespan of more than 30, 40 or even 100 trading days because they also haven't very big sizes, aren't overscaled, and also, like it's there, close losers sooner. So they accept to lose sometimes with small parts of their accounts, and this separates a good trader from a bad trader. The third point is by selecting your trades, fewer are created. However, when they do occur, both attributes are in the green zone. So risk reward and hit rate are oftentimes in the green and not like the bad traders in the red. And this is because they don't trade as often as the bait traders. Like I told you, myself, I trade 1, 2 or maximum 3 trades per day. But when I do these trades, I look up to my risk reward ratio. I look up what can I lose, what can I get, and what are the probabilities that my trade will work or not. And therefore, or because of this, I'm trading very good. And most of the traders don't plan their trades. And if you don't plan your trade, you can't even look up your specs. So have I gotten a good risk reward ratio, or what are my probabilities? Did I research my strategy? Have I a good hit rate? Do I have a good hit rate or not? And so if you don't do that, it's more likely that you will have red stats and not green stats. So what is the resume of this video? What can we learn from the statistics? So first of all, risk management is the most important thing in prop trading. So doesn't matter which prop firm you are using, risk management is always key to success. So that means you have to improve in your risk management, and I think you know it deep in yourself. If you look up to and you know you're not profitable, that your risk management isn't on point. So first, number one rule is always look at your risk management. What can you do better? What do you have to adjust to do better? And what can you also do it for your personality, because many personalities can't take big stop losses, so they have to get a high hit rate and then maybe not a good risk reward ratio, but you have to adjust the things to become better and to make yourself feel comfortable in these funded accounts. So risk management number one for sure. Also, many times the people, because scalping is very popular nowadays, are scalping, but most of the scalpers failed. So we looked up into the beginning, 70% or up to 70% of the traders that are scalping or losing their accounts are scalping. So scalping is one of the baddest trading styles you can do. And even if you have a coach, or even if you looked up and you like this style very much, it's likely or more likely that you could be profitable in just changing your trading style. Maybe switching from the M1 or M5 time frame to M15 or 30, and therefore you will have much or you will do less trades, but these trades that you are doing will be better. So could be one point that you have to change. Also, number three, do fewer trades, because often it's better to trade less. I think you know it deep down in yourself. When you do many trades, the trading day doesn't feel as good as when you have 1 or 2 or maybe 3 trades a day, which are very good and selected. So only do A++ trades that are selected, that are planned, that are very good and likely or most likely to go in your direction, and select your trades better. So fewer trades are often better as many trades per day. The last point is that trading many different markets is negative. So become a specialist in 1 or 2 markets. Become the best of yourself in those markets. Maybe also look at the fundamental, what are the news saying, what is the structure of the markets, how is the liquidity, and what are the important key things of the markets, so that you can become really a professional in those markets. Many times where the traders switch markets, GC, oil, ES, Nasdaq, HG, so copper maybe, they are very or most likely to have a negative performance because they can't adapt to 1 or 2 markets, and so they don't become a specialist like a doctor. Once become a surgeon, one become a dentist. So become a specialist in one of your markets, and then if you are becoming, or if you became a specialist and know exactly how the markets work, and if you're profitable, then you can maybe add 1 or 2 markets. So thank you very much for watching. If you liked the video, don't forget to like, comment and subscribe. As you know, and as I said in the beginning, these videos are also that I can practice my English, and also that I can give you very good information, because there are videos that are coming up next that will be very interesting for you. So yeah, don't forget to subscribe. And also, if you want to trade on Apex Trader Funding, you can also use the code ALFA for the best deals. You can support this channel, and yes, would be very nice. So thank you for watching, and let's see us in the next video. Bye.